Hello, welcome back. Let's talk about the connection between the stock market and high inflation. And I will show you in this video that losses in the stock market, particularly at the beginning of an inflation period, is nothing unusual. In fact, you should expect such losses to happen. So let's look into this. Now let's go back into my 4 phases inflation management model. You know it from my book, The Return of High Inflation. Any inflation period goes through 4 phases. And if you are a big company, like my clients that I work with, then you need to understand that each phase is completely different and needs a different strategy. And that's the same in the stock market or for investors. And let's look into this in a little bit more detail. So you have the pre-inflation period. That's typically inflation is low, doesn't move that much. That's what we have seen in the past. Like the last 10 years before inflation started to go up recently. We have interest rates going down, economic growth very benign. Credit is available. You can go to the bank, you get your mortgage, you get corporate loans. They're widely available and at very low interest rates. Corporate earnings are great, unemployment rates are very low, and business readiness to invest is pretty high. So it's almost paradise situations, and that's the tricky thing for investors, right? Because this is typically the time when stock markets reach new market highs. And we have seen that in this inflation cycle, that we had new records in the S&P 500. And then comes the inflation shock. That's when basically everything turns negative, right? And here's the trick. Normally, people are not prepared for this. And that includes the regulatory side, the central banks, the politicians, business leaders. So everybody gets caught on the wrong foot. Inflation goes up, interest rates go up, economic growth goes down, there's fear of a recession, banks getting really cautious, they don't want to lend that much anymore, right? And that's the most tricky phase in an inflation cycle. And that's where we are right now. It's now May of 2022. Inflation shoots up, then it stays on a high rate for a while. That's phase 3, and then it comes down. I will talk about these 2 phases later and their impact on the stock market. It's also very interesting what's happening here. But let's focus on what's going on right now. We are in this phase of an inflation shock. It's a classic inflation shock. People didn't see it coming. Companies were not prepared. And so supply chains are not ready. Really classic situation. And we had the same thing happening in 1973 and 74. And let's look what happened back then. Now here you see the inflation shock. We had 2 really good years with real economic growth north of 5%. And then it crashed. Inflation shock set in 74 and 75, recession. Unemployment rate shot up. There was a lot of very desperation around. And what did the S&P 500 do? Well, let's look a little bit closer. I'm gonna zoom in on this chart. Now here you have the S&P 500 before the inflation shock, January 1973, and right after, basically, October 3rd in 1974. So we're talking about roughly 18 months, 19 months, and the S&P 500 during that time frame lost almost half of its value. You know, in the 70s, stock markets didn't move that fast as they do today. There was no online trading. If you remember that time, even in the 80s, you had to call your broker, they write a ticket, you would probably find out the next day whether you got the stocks or not. So everything was a little bit slower. So this happened over a longer time period, but we went down 48%. That's dramatic. That's half of the value that was lost during this inflation shock. So that's something that's very normal, and you should expect in an inflation shock that stock markets get a lot of pressure, particularly if they have reached an all-time high before. Let's look a little bit more closely in what happened there in terms of relative valuation. Well, we went into that period with a relatively high PE ratio. For the S&P 500 back then, the actual ratio was 18, and it went down to something around 7.5. And so we have a similar situation. That's why I write here today's equity valuation similar to back then. We went into almost with an all-time high just before the inflation shock happened. And obviously there's a lot of hot air that can deflate. So if we summarize what we have learned today, so don't be surprised if stock markets get under pressure. The time, let's just go back again. These two phases are so different from each other. They are from paradise to hell. And when you lived in the 70s, that was really a shock for everybody. In addition, we had the oil shock back then and a lot of political instabilities in some countries. So, not surprisingly, it was a completely different world. And equity investors were very slow to realize what happened back then. Except one equity investor, and that was our friend Warren Buffett. When these markets came down, Warren Buffett was the one who was ready. He had a lot of cash. He was in fact one of the few people who had a lot of cash. If you look at his annual report that is about the year 1972 and 1973, and you look at the balance sheet, he had a lot of cash. So when stock market came down, he was one of the few people who took advantage of these low valuations. So please rethink these superficial slogans like cash is trash. There's always a situational context. Let me repeat this. You have to understand the situational context. Yes, over a long period of inflation, if you always have cash, like in Venezuela, when you have inflation for 20 years, you don't want to keep cash. But there are periods where the situation demands to have cash. Wouldn't you like to be one of the people who went into this period with a lot of cash? Of course, like Warren Buffett, you started buying all the companies at a big discount. So please look at this situation in the 70s. You can learn a lot about this. If you want to, I have a whole chapter. It's actually chapter 10. It walks you through every phase of the 1970s and explains what happened on the inflation side and on the economic side, and what would have been, in retrospect, what would have been the best solution to deal with this. So that was it for today. Quick update. There's a little bit more about the connection about stocks and inflation and how the mechanics work and how goodwill and all these things work. We do that in the next video. If you like it, please subscribe to my channel. There's more to come. And if you have any questions, put them in the comment section. Thank you very much and all the best.